US jobs growth was a bit weaker than expected, but wage growth was solid, something for everyone in the debate over a soft landing. China's outlook, though, is different and crucial. We get key inflation data this week from China. That's coming up in our 5 Things in less than 5 minutes. And in our deep dive, we hear from Wang and Daniel Hynes about how Australia's exporters should benefit as India takes up the slack in commodities demand left by China's slowdown.
India's import dependency is very high, and that will align with the markets that Australia is most dominant in.
But first, in 5 and 5 with ANZ, number 1, non-farm payrolls data out on Friday night showed jobs growth in the world's largest economy is slowing, which was seen pleasing the US Federal Reserve. There were 187,000 jobs added in July. That was less than the consensus of around about 200,000. But it wasn't all good news for those hoping for a soft landing. Average hourly earnings growth was unchanged at 4.4% in July from a year ago. That was a touch above the consensus. Here's ANZ Group's chief economist, Richard Getzinger.
The payrolls, I think, was in many ways a microcosm of the recent US data trend. If you're thinking the US is going into recession, there was a little bit there for you. If you're thinking the Fed's getting the soft landing and the immaculate landing, if you like, that maybe it's after, there was a bit there for you as well. I think that's a good signal. It's telling us the Fed's somewhere in this not too hot, not too cold kind of territory.
Number 2. However, US bond markets ended the week slightly happier with the renewed indicators of a soft landing. The US 10-year Treasury yield eventually closed down 2 basis points at 4.04% on Saturday. As recently as Thursday, it was a 9-month high. That's because of fear about extra US government borrowing. The 2-year yield also fell 2 basis points, which means the yield curve is still negative. Now, that used to be a surefire indicator of a recession. Not so much anymore, as ANZ's senior international economist Tom Kenny explains.
Given that we haven't really had that many recessions, it's not really an ironclad rule, I think, for the negative yield curve that a recession necessarily seems to follow. We're not really seeing any signs of a growth slowdown yet in the US economy. So short-term rates are high because the policy rates are high, but the longer-term rates are lower because there's an expectation that, at some point the Fed will be cutting rates because, policy is restrictive at this point in time.
Number 3, oil prices rose another 1% to nearly $83 a barrel for West Texas Intermediate over the weekend. And remember, it's up more than $10 a barrel over the last month. Tightening supplies from Saudi Arabia and Russia are a factor, along with some worrying signs the conflict in Ukraine could hit gas and oil supplies, especially through and around the Black Sea. Ukrainian drones hit one of Russia's biggest oil tankers over the weekend. ANZ's senior commodities strategist, Daniel Hynes, talks about fears too for European gas.
Europe is certainly at risk of being completely shut off. We saw Russia warn that supplies through the Ukraine are certainly not guaranteed at the moment.
Number 4, the RBA forecast inflation is to fall under 3% by the end of 2025 in its statement of monetary policy on Friday. Here's ANZ's head of Australian economics, Adam Boyton, on what that means.
The bank is happy to sit back for some time and see how inflation and activity across the economy evolve. The key for me when I'm looking at forecasts in the RBA's quarterly statements on monetary policy is what's the endpoint inflation forecast? That is, where does the bank think inflation lands at the end of its forecast? We've got 2.8 for headline inflation come December 2025. It's within the band. It's a slow return to the band, but that for me is on hold, but with a hawkish tinge.
Number 5, the key thing to watch this week will be China inflation figures on Wednesday, with deflation expected for both CPI and PPI inflation in July. Here's Tom Kenny on how China's recovery really is different from everyone else's, especially with youth unemployment over 20% and climbing.
There's talk there of household balance sheet recessions. It's looking very challenging for the Chinese government there to try and stabilise growth going forward.
Tom Kenny there. Now it's time for our deep dive in less than 5 minutes. On Friday, we heard from ANZ's Sunny Kumar in India about how India could take up around half of the commodities demand slack left by a slowing China. So, who benefits from that increased India demand? ANZ's Betty Wang asked Daniel Hynes in a webinar for ANZ clients last week about how this China to India shift affects Australia.
So clearly the metals will certainly benefit from that. But even non-critical minerals, which I sometimes do place copper in as, but certainly it's the production of more traditional metals like copper and other raw materials, could clearly benefit from this in an overall sense, considering the growth that we'll see come out of India itself. And then on the energy side, certainly with gas taking a much more important part of the energy mix within India, that's going to be an area where Australia can benefit. It is one of the biggest exporters of liquefied natural gas. And due to its relatively short distance, it is a key market for Australian exporters as well. So, it does open up a huge amount of opportunities. Not that Australia hasn't been taking advantage of them so far, but clearly there is much greater scope, I suppose, for Australian exporters now to deliver into this huge growth driver.
Sure. Sounds like opportunities are quite there, particularly for traditional energies as well as some critical minerals. Another trend that we've been observing for quite a while is the rising global awareness of decarbonization and energy transition. And in fact, actually, India has made its own commitment to decarbonize by 2070. So Daniel, what do you think, if this energy transition happens and, decarbonization efforts are taking place in India? So what does it mean for commodities demand and also for clean energies? Is there any views on that?
Yeah, I mean, a huge impact. Countries like India, have been dominated by fossil fuels as opposed to, I suppose, more developed markets like Europe and North America, where there's been a much earlier transition and we've seen a much greater diversity, I suppose, amongst energy sources. In terms of primary energy, India relies quite heavily on coal and oil at the moment, which make up, about 2/3 of that primary energy demand. But when you look at the electricity sector in particular, coal's share is even greater at nearly 80% at the moment. And it wants to cut that down to about 50% by 2040. So there's going to be a huge transition within that market. It's obviously targeting quite a large sort of build out of electricity capacity, essentially doubling the capacity over the next 10 years. A lot of that will come from solar and wind, which are huge consumers of a lot of those critical minerals. Clearly, though, the issues around air pollution and decarbonisation are a major issue in India. It has been an environmental problem for the country for some time. In fact, in, I think, 2019, over 1 million premature deaths were associated with ambient and household air pollution. So it is a major issue, and that's why I think natural gas will be that key transitional fuel for India in particular, much more cleaner burning fuel, and allow it, as a perfect transitional fuel until, I suppose, some of those renewable energy sources get up to a large market share. And then, of course, the electric vehicle sector. India is quite a unique market in that it is dominated largely by 2- and 3-wheeled vehicles. And the opportunity, I think, is huge within that sector, as opposed to the issues of mileage or coverage, by heavy vehicles or cars due to the lack of storage capabilities in batteries. The 2- and 3-wheeled have much shorter operating ranges, and as a consequence, the ability to meet those needs from current battery technology is huge. So I would expect to see a really strong pickup in demand from electric vehicles on those 2- and 3-wheeled sectors, which will really boost demand for a lot of those critical minerals.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, August the 7th. Catch you tomorrow. This podcast was recorded for publication on behalf of ANZ. All associated disclosures and disclaimers can be viewed using the link in your media player or the ANZ website through which you access this podcast. All care has been taken to report the views of ANZ Research in the creation of this podcast, but as an independent host, any differing interpretations are strictly mine and not ANZ's. Feel free to contact your ANZ point of contact with any questions.